Hello, everyone. I'm Dr. Jessica Woolworth, a practicing CPA and an accounting professor. In this episode, we're starting Chapter 2 with something surprisingly practical and honestly something everyone should know: who actually has to file a tax return, when it's due, and how long the IRS can come back and question it. Because taxes aren't just about calculating numbers, they're also about deadlines and rules, and missing those rules can get expensive fast. Let's start with the basic question: who has to file a tax return? For corporations, it's simple. All corporations file every year, even if they had zero income. For individuals, it depends. It depends on three things: your filing status, your age, and your gross income. So there isn't one universal number. For example, a single college student might not need to file if their income is very low, but someone married filing jointly usually has a higher threshold. And once your income crosses that line, filing becomes required, not optional. And even if you aren't required to file, sometimes you still should. Maybe taxes were withheld from your paycheck and you want a refund, or maybe you qualify for a credit. So, not required doesn't always mean don't file. Next up, deadlines. This is where most people think they know the rule, but there are actually a few variations. For individuals, your return is due on the 15th day of the fourth month after year end. So for most of us with a December 31st year end, that's April 15th. Corporations generally follow the same idea, but partnerships and S corporations are due a month earlier. And that difference matters, especially if you're preparing multiple returns in practice. Now, here's something students always ask me. What about extensions? An extension gives you more time to file the paperwork. It does not give you more time to pay. That's a really important distinction. If you owe money, the IRS still expects payment by the original due date. The extension only buys you time to finish the forms. So think of it as extra time to organize, not extra time to delay taxes. Now, let's talk about something that sounds legal and intimidating, but is actually very simple: the statute of limitations. This just means, how long can the IRS come back and audit or assess additional tax? In most situations, the answer is 3 years. 3 years from the later of the due date or when you actually filed. So once that window closes, that tax year is generally off the table. But there are exceptions. If someone omits a large chunk of income, more than 25%, the window can extend to 6 years. And if there's fraud or someone never files at all, there's no time limit. It stays open forever, which is exactly why filing matters, even if you can't pay right away, because not filing keeps that year permanently exposed. So here's the big picture. This chapter isn't just rules and bureaucracy. It's about protecting yourself. File when required, know your deadlines, understand how long records matter. Because good compliance isn't exciting, but it saves a lot of headaches later. In the next episode, we'll talk about something students are always curious about: how the IRS actually chooses returns for audit. Got a tax topic you're curious about? Drop it in the comments. I might cover it in a future video. If you found this helpful, feel free to like, share, or follow depending on where you're watching. And just a reminder, this video is for informational and educational purposes only. Everyone's tax situation is unique, so be sure to consult with a qualified tax professional before making any decisions about your taxes. Thanks for watching, and I'll see you in the next one.